Before we start this video, I just want to say thank you for your interest in these topics. I've done a lot of work so we can be informed on the title of this presentation. The U.S. Economy and Markets Information Summary 2025, first of 3 per year. Fiscal and Monetary Policy Questions. Steve Campbell in Collin County, North Texas. Economics and Investments Researcher. My LinkedIn profile is there. I've taken the Kaplan exam prep courses, Series 7 and 63. I have my bachelor's in Business Administration, Finance and Investments from Baruch College, City University of New York, and I attended St. Augustine High School, New Orleans, Louisiana. You want to know? Know where to go. Global GDP and GDP of selected countries. Global domestic product increased to $110 trillion from 2023 to 2024, with greater than $2 trillion of GDP in 2023. The top countries included the US, China, Germany, Japan, India, and the UK. Countries considered to be emerging markets and developing economies, EMDEs, and I will give 6 examples, are Iran, South Africa, Pakistan, Iraq, Ukraine, and Jordan. Investopedia defines GDP as the total market value of all the finished goods and services produced within a country's borders in a specific time period. GDP defined and GDP formula, the expenditure spending approach. GDP can be calculated by 3 approaches: expenditure, output, or income. We will use the most common, expenditure or spending approach, equal to C plus G plus I plus NX, personal consumption plus government spending plus investment, capital spending by businesses, plus net exports, exports minus imports. A country's GDP encompasses all private and public consumption, government outlays, investments, additions to private inventories, paid-in construction costs, and the foreign balance of trade. Exports are added to GDP, imports are subtracted from GDP. 2025 projections for the global economy. The World Bank Group projected the global economy will expand 2.7% in 2025. Developing economies should hold steady at 4%. Advanced economies, including the US, are forecasted to grow 1.7%. US GDP percent changes and the top 4 states contributing to US GDP. The US Department of Commerce's Bureau of Economic Analysis, BEA, showed the real GDP percent change from the third to the fourth quarter 2024 was 2.4%. Federal Reserve Economic Data, FRED, showed annualized U.S. gross domestic product was 29.723 trillion at end of year 2024, an increase of 2.8% from 2023. Using the World Bank Group's 2025 GDP projection for advanced economies, the U.S. GDP should grow by 1.7%, which will result in an end-of-year 2025 GDP of $30.228 trillion. The top 4 U.S. states in descending order by 2023 GDP are California, Texas, New York, and Florida, all with GDPs greater than $1 trillion, but less than $3.3 trillion. U.S. deficits, national debt, and interest on debt by formula and by debt clock. The fiscal data at the U.S. Treasury showed during the Trump-Pence administration, 2017 to 2020, the U.S. national deficit grew 367% from $670 billion to $3.13 trillion. And the national debt increased 33% from $20.244 trillion to $26.945 trillion. During the Biden-Harris administration, 2021 to 2024, the deficit shrank 34% from $2.77 to $1.83 trillion. But the debt grew 25% from $28.428 to $35.464 trillion. 2024 average interest rate was 3.32%. By mathematical formula, interest on national debt of $35.464 trillion was $1.77 trillion. By the March 28, 2025 debt clock, the national debt had grown to $36.653 trillion, and the interest on debt was $1.014 trillion. Should U.S. fiscal policy move to a national debt at the end of 2025 of $32.627 trillion, an 8% reduction? Should we hold President Trump to this goal? Let me know in the comments. National debt, population, national debt per capita, national debt to GDP, and credit ratings, selected countries. January 19th, 2025, we see at the World Debt Clock the national debt, population, debt per capita for 8 countries. In first place was the United States with $109,210 of national debt per capita. In second place was Japan with $95,396 of national debt per capita. With the large populations of China and India, China's debt was $11,000 per capita, based on an official population of 1.4 billion people, and India's debt was 2,500 per capita. Independent investigations into the official population numbers of China, presented by Lay of Lay's Real Talk, have concluded: 1. With official population and fertility rate figures being overstated in the years 2000 and forward, and 2. With pandemic and outbreak deaths, the population now is only 400 million people, not 1.4 billion people. For her methodology, see YouTube channel Lay's Real Talk. LEI''S. Website leisrealtalk.com. And 3 videos. First, December 14th, 2024. How I used AI to calculate China's real population. Second, March 4th, 2025. China's deadly outbreak. Silence, cover-ups, and quarantine camps. And third, April 4th, 2025. China's population is just a fraction of 1.4 billion. Also see YouTube channel China Deep Dive. Video: How much has China's population decreased? Shocking. It explains many questions. Now, China's adjusted population figure brings up the national debt per capita figure to 39,518. The national debt to GDP ratio as of January 5th for Japan was 255%, followed by Italy at 134%. The United States at 123% followed Italy. Brazil, China, and Russia, 3 of the BRICS countries, had debt to GDP ratios of 84%, 83%, and 14% respectively. Moody's gave Germany a stable outlook, but to the US, a negative outlook. Germany has a better credit rating profile than the United States. S&P gave Germany a rating of AAA, but to the US, AA+. Germany's national debt to GDP ratio is 62.9%. The US's national debt to GDP ratio is almost double that, at 123.18%. Before the April tariffs from the US, the credit ratings for China and Japan were equal. But China's national debt to GDP ratio was 83%, while Japan's was more than double at 255%. China's GDP was 3.932 times Japan's GDP. China's GDP was $17.794 trillion to Japan's GDP of $4.525 trillion. China's commercial and residential real estate market crisis is so bad, it must be the cause of its country's low credit rating. Revenue collected by the United States government, the trade deficit, and the national debt to revenue ratio. The 2024 U.S. national debt, $35.464 trillion. This is against only $2,258 billion revenue collected by the United States government year-to-date in fiscal year 2025, October 2024 to March 31st, 2025. 50.60% was individual income taxes, $1,140 billion. 0.57% was estate and gift taxes, $13 billion. 7.15% was corporate income taxes, $162 billion. 2.087% was excise taxes paid by manufacturers, producers, $47 billion. 1.93% was custom duties, tariffs on imports, $44 billion. The U.S. trade deficit was $918.4 billion in 2024 and $784 billion in 2023. In February 2025, it was $122.7 billion and rising. Returning to revenue categories, 36.89% was Social Security and Medicare taxes, $834 billion. 0.78% was miscellaneous income, $18 billion. These 7 categories total 100%, collected October 2024 to March 2025, is $2,258 billion. Using the 2024 national debt figure, $35.464 trillion, the U.S. national debt to revenue ratio is 1,571%. Top trade balance and current account balance countries. When we looked at government income from custom duties, tariffs on imports, we took a quick detour to mention the U.S. trade deficits for 2023, 24, and 25 to date. Let's broaden that mention to a discussion. The top 5 trade balance countries of 2024 were China, Germany, Ireland, Singapore, and Switzerland. The country of consumers, the United States, was ranked 190 for trade balance. The current account formula is the result of exports minus imports plus net income plus net transfers. The top 5 current account balance countries of 2024 were Germany, China, Japan, the Netherlands, and Singapore. The country of consumers and the country destined to receive foreign direct investment, FDI, the United States, was ranked 190. Its bottom-ranked current account balance underscores the weight of the U.S. trade deficit on its current account balance and ranking thereof. Should U.S. fiscal policy move us to a current account balance ranking of 150, currently held by the Maldives, and a trade balance ranking of 175, currently held by Panama? Should we hold President Trump to these goals? Let me know in the comments. The current account balance would have to move from negative $1,130 billion to negative $1.4 billion. That would be a $1.129 trillion improvement, a 99% change for the better. The trade balance would have to move from negative $1,202.3 billion to negative $3.73 billion. That would be a $1.198 trillion improvement, also a 99% change for the better. By staying where we are in the rankings, what pains come with that rather than changing our rankings for the better? The pains of staying at 190 out of 195 countries. Number one, growing debt and interest payments. Chronic deficits mean the U.S. must borrow more from abroad to finance consumption and investment. As interest rates rise, the cost of servicing that debt increases, crowding out public investment in infrastructure, education, and innovation. Number two, loss of economic flexibility. A country reliant on foreign capital becomes vulnerable to shifts in global sentiment. If investors lose confidence in the United States, capital flight or currency devaluation could follow. Number three, dependency on imports. With a bottom-ranked trade balance, the U.S. produces less of what it consumes. That weakens domestic industries, contributes to job outsourcing, and leaves the country exposed to supply chain shocks. Number four, geopolitical leverage slippage. Countries with strong surpluses like China and Germany gain global influence and financial flexibility. A persistently weak U.S. balance could erode its ability to use economic tools diplomatically or to be a leader in trade negotiations. Number five, domestic inequality and inflation sensitivity. Over-reliance on cheap imports can mask structural economic weaknesses, but makes the country highly sensitive to inflation if or when global prices spike. The benefits of consumption-heavy growth often flow disproportionately to the wealthy, while wage stagnation persists for many. Staying at a ranking of 190 may seem manageable in the short term, especially for a country with the dollar's privileges. But over time, it erodes resilience, limits policy options, and leaves the economy exposed to external shocks. Improving the rankings isn't just about prestige. It's about building for the decades ahead a more self-reliant, stable, and strategically positioned economy. outstanding treasuries, ownership, marketable and non-marketable treasuries. Treasuries outstanding year-end 2024, $28.5 trillion. We're near the year-end 2021 level, $28.4 trillion, because the Federal Reserve reduced their holdings of treasuries and foreign holdings of treasuries decreased. At the end of 2021, we see the Fed owned $5.652 trillion worth of treasuries. But by the end of 2024, the Fed reduced its holdings to $4.265 trillion. The Bank of Japan, BOJ, and the People's Bank of China, PBOC, the number one and number two foreign holders of U.S. Treasuries, also reduced their holdings. Japan from 1.3 trillion to 1.098 trillion, and China from 1 trillion to 768 billion. I can say there are two types of treasuries. The first type is held by the Federal Reserve, foreign countries, mutual funds, ETFs, banks, pensions, insurance companies, and other. These treasuries are marketable securities. They cover approximately 80% of national debt. My second type are non-marketable securities, held by intragovernmental agencies such as the Social Security Administration trust funds, the Medicare trust funds, the Civil Service Retirement Fund, etc. They cover approximately 20% of national debt. Quantitative easing, QE. The Fed expanded its balance sheet. 1913 to 2008, the Federal Reserve owned treasuries for fine-tuning monetary conditions in the United States economy. 2008 brought the quantitative easing, QE, that was balance sheet expansion. Quantitative easing number 1, QE1, during the financial crisis in late 2008, had the Fed for the first time purchasing mortgage-backed securities, MBS, for credit market intervention due to the collapse in the housing market and the need to support mortgage lending. The goal of QE1 was to push down long-term interest rates, unfreeze credit markets, boost confidence, and encourage borrowing and spending. QE2, which focused on treasuries, had the goals of encouraging borrowing and spending, boosting investment, raising asset prices of stock and real estate, and avoiding deflation. Inflation had fallen below 2%, all promoting a stronger pace of economic recovery. The goal of QE3 was to stimulate the labor market, keep mortgage rates low, and signal long-term support. Quantitative easing asset purchases were sometimes 100% treasuries, but also 67%, 50%, 30%, and even as low as 25% treasuries. The Federal Open Market Committee, FOMC. The Federal Open Market Committee, FOMC, is charged under U.S. law with overseeing the nation's open market operations, the Fed's buying and selling of U.S. Treasury securities. It meets 8 times a year. This committee is the monetary policy making body of the Federal Reserve System. It makes decisions about interest rates and the money supply to influence the economy. For its May 2025 two-day meeting, the FOMC maintained the Fed funds rate target range, the interest rate range at which banks lend reserve balances to other depository institutions overnight, at 4.25 to 4.5%, to meet its 2% inflation and maximum employment goals. Core inflation in the United States was 2.8% in March 2025. The European Central Bank, ECB, also targets 2% inflation. China's government aims for 3%. The CPI and purchasing power, U.S. money supply, and monetary dilution. While we hold on to the thought of a U.S. inflation rate target of just 2% and missing it by 0.8%, from 2001 to 2025, the change in CPI has been from 174 points to 319.08 points, 83.38%. That decreased purchasing power to 54.53 cents on the dollar. We have lost 45.47 cents due to inflation, but even more due to monetary dilution. At the end of 2000, the U.S. money supply, M2, was $5 trillion. February 2025, M2 was $21.74 trillion, a 334.8% increase. $1 from end of year 2000 became worth 23 cents in February 2025, having lost 77 cents on the dollar due to monetary dilution. Should U.S. monetary policy move to reduce losses of purchasing power and lower percentages of monetary dilution? Should we hold the Federal Reserve to these goals? Should we hold President Trump to doing his part for reaching these goals? Let me know in the comments. Growth of the money supply globally and in selected countries, and monetary dilution. At the end of 2000, the global money supply was $26 trillion. End of year 2024, it was $129 trillion, a 396% increase. $1 became worth 20.16 cents, having lost 79.84 cents on the dollar due to global monetary dilution. The top 6 countries or regions and their money supply increases under the United States' 334.8% money supply growth are Canada at 228%, Euro area at 224%, Sweden at 221%, Japan at 110%, the United Kingdom at 100%, and Switzerland at 94%. The weight of the United States and the top 6 under it were 334.8% and less, but the global money supply increased by 396.2%. What country or countries brought the global money supply percentage increase higher? China at 2,200%, Russia at 1,900%, India at 1,700%, and Brazil at 700%. From end of year 2000 to February 2025, the U.S. money supply increased 334.8%, from $5 trillion to $21.74 trillion, diluting the purchasing power of the dollar from $1 to 23 cents. From end of year 2000 to end of year 2024, the S&P 500 index grew from 1,320.28 to 5,881.63, 345.48%, barely better than the money supply. 345.48% minus 334.8% equals 10.68% better. A $1 investment in the S&P 500 turned into $4.4548. But from a purchasing power perspective, that 4.45 had to be multiplied not by $1, but by 23 cents to maintain purchasing power. 4.4548 times 0.23 equals $1.02. So the return on purchasing power was 0.02%. All those years. New Year's Eve 2001 to February 2025. All of those younger days when I and you were younger, working, commuting, saving a portion of our income, investing, being responsible, hoping, planning, knowing it would pay off. It paid off all right. 0.02%. 2 cents. 2 cents on every dollar of purchasing power. After 23 years, we could say from 2001 to 2024, a person's wages could have increased from $35,000 to $70,000 or more, or less. But also, an older person could have passed peak wages, and $70,000 or more, or less, has now decreased to $25,000. Wage growth and growth of consumer loans. But what happened with wage growth? The Employment Cost Index, ECI, tracks how much it costs employers to hire and keep employees. The ECI provides valuable insights into the inflation of labor costs, including wages and employer-paid benefits. It is a key economic indicator used by policymakers and businesses to understand labor market trends and make informed decisions. The ECI went from 150.6 in 2001 to 167.4 at the end of 2024, an increase of only 11.155%. What happened during the same range of time with the growth of consumer loans? They went from $232 billion to $1,083 billion, increasing 366%. Growth summary: money supply, consumer loans, S&P 500, consumer price index, and employment cost index, wages. The CPI increased 83%. The U.S. money supply increased 334%. Consumer loans increased 366%. And the ECI, wages, increased only 11%. And if you were able to save a portion of your wages for investing, the S&P 500 increased 345%, which in purchasing power terms was a return of 2 cents on the dollar after 23 years. Wages did not keep up with money supply growth or CPI growth. Consumer Price Index, CPI, items. Now, let's look at inflation not over 23 years, but over 12 months. In March 2025, the CPI all items 12-month change was 2.4%. Core inflation, CPI all items excluding food and energy, for March 2025, as we saw on slide 8, was 2.8%. Here on slide 11A, we see some of the items of the CPI. Slide 11B starts with an insertion of the front month crude oil 1-month futures, ticker symbol CL equals F. Crude oil has fallen from $73.16 to $68.37. So maybe the CPI item, gasoline all types, will have a decrease in 12-month change. Returning to the remaining CPI items, beginning with gasoline all types, we see that is correct. Of all categories on both slides, 11A and 11B, motor vehicle insurance had the highest 12-month change, 7.5%. Income, disposable income, savings, and consumer spending. According to the March 2025 estimates released by the U.S. Bureau of Economic Analysis, personal income increased 0.5% at a monthly rate, an increase of $116.8 billion. Disposable personal income less personal current taxes, increased 0.5%, an increase of $102 billion. Personal savings increased 3.9%, an increase of $872.3 billion. And consumer spending, the value of goods and services purchased by or on behalf of U.S. residents, increased 0.7%, an increase of $134.5 billion. Consumer confidence, expectations index, CEO confidence, and GDPNow. The Consumer Confidence Survey reflects prevailing business conditions and likely developments for the months ahead. This monthly report details consumer attitudes, buying intentions, vacation plans, and consumer expectations for inflation, stock prices, and interest rates. The Consumer Confidence Index for the end of the first quarter of 2025 was 92.9 points after falling 7.2 points. The Conference Board also has an expectations index based on consumers' short-term outlook for income, business, and labor conditions. Scores below 80 can signal a recession is ahead. In February, the score was 72.9, and the score worsened in March, falling to 65.2, a 12-year low. The Conference Board measure of CEO confidence, in collaboration with the Business Council, is a barometer of the health of the U.S. economy from the perspective of U.S. chief executives, based on their perceptions of current and expected business and industry conditions. This survey gauges expectations about future actions their companies plan on taking in capital spending, recruiting, employment, and wages. The CEO Confidence Index for first quarter 2025 is up 9%, or 9 points, to 60 from fourth quarter 2024. A total of 134 CEOs participated in the survey, 27% if there were only 500 companies. Still, CEO confidence moved from cautious optimism to less cautious optimism. The Atlanta Fed publishes a quarterly growth estimate called GDPNow. On March 3, 2025, the first quarter estimate was negative 2.80%. U.S. Treasuries, Ylds, and the yield curve. The April 30th 3-month T-bill yield was higher than the 10-year T-note yield, showing us an inverted yield curve for the 10-3. The 2-year T-note yield was lower than the 10-year T-note yield, showing us a normal yield curve for the 10-2. The 30-year T-bond yield fell from 7.9% January 31st, 2025 to 4.577% on April 30th. Lower yields here suggest caution for an economic slowdown. Mortgage rates, purchase and refinance, 30-year and 15-year rates. March 20th, 2025, a 30-year fixed mortgage for a purchase has a national average interest rate of 6.72%, APR 6.77%. If that were a refinance, the national average would again be 6.72%, APR 0.01% lower, 6.76%. March 20th, 2025, the 15-year fixed mortgage for a purchase has a national average interest rate of 5.97%, 6.05% APR. Its refinance would be 5.98%, 6.06% APR. Credit spreads, 3-year T-bond yield versus AAA and BB corporate bond yields. A U.S. high-quality AAA corporate bond has a higher yield than a 30-year U.S. T-bond because of the premium of its higher investment risk. According to the International Exchange Partnership with Bank of America, ICE BOA yield, posted on the St. Louis Federal Reserve Economic Data (FRED) website on April 30th, 2025, a U.S. AAA corporate bond could be found at 4.65%, with a 30-year T-bond on the same day having a yield of 4.577%. The risk premium was only 7.30 basis points. A U.S. non-interest grade BB corporate bond has a higher yield than a 30-year U.S. T-bond and a AAA corporate bond because of the premium of its even higher investment risk. On April 30th, the ICE BofA U.S. high-yield corporate bond yield could be found at 7.69% against the 30-year T-bonds 4.577%. The risk premium here was 311.30 basis points. When the spread or premium risk between high-yield corporate bonds and 30-year T-bonds become too small, less than 225 basis points, the market knows that should not happen, as it did on January 31st at 219 basis points in red and bold. Comparison of the current 3-month T-bill yield to 2 money market yields and their performances. When a money market fund lists its yield, the expense ratio has already been subtracted. March 20th, the 3-month T-bill yield was 4.294%. March 19th, the Vanguard Federal Money Market Fund compound yield was 4.30%, and the Fidelity Government Money Market Fund compound yield was 3.96%. The global and U.S. business cycles and the U.S. Leading Economic Index, LEI. In the business cycle, there are 4 phases. 1. Expansion. 2. Contraction to recession. 3. Depression. And 4. Recovery. In Q1 of 2025, global business was in a variety of phases of expansion. The U.S. was at mid-cycle expansion, prolonging its experience of expansion. Japan, Australia, and South Korea were a little past mid-cycle expansion with inflationary pressures. Beyond them were Mexico, Brazil, and India. Then the UK. After the UK, the Eurozone was entering contraction. Canada was pulling away from the lowest point of contraction, and China was beyond Canada and leaving the lowest point of contraction. Some economists say a shock, such as tariffs, to a weak economy can push an economy out of expansion to the next phase, contraction or recession, or pull it back from recovery to contraction. The Conference Board U.S. Leading Economic Index, LEI is composed of 10 components. 1. Average weekly hours in manufacturing. 2. Average weekly initial claims for unemployment insurance. 3. Manufacturers' new orders for consumer goods and materials. 4. The Institute for Supply Management, the ISM, Index of New Orders. 5. Manufacturers' new orders for non-defense capital goods, excluding aircraft orders. 6. Building permits for new private housing units. 7. S&P 500 Index of Stock Prices. 8. Leading Credit Index. 9. Interest rate spread, 10-year Treasury bonds, less federal funds rate. And 10. Average consumer expectations for business conditions. For the LEI, the Conference Board sets the year 2016 as 100. An index of less than 100 signals progressively weak economic conditions, and an index of more than 100 signals progressively strong economic conditions. Since the year 2000, the index has ranged from 74 to 120. The LEI continually fell from where it was at the end of 2024, 101.8 to 100.5 in March 2025. When we looked earlier at the Conference Board's Consumer Confidence Index, Expectations Index, CEO Confidence Index, they were leading on average for 3 months or less. Here, the indicators lead longer, for 7 months on average. Nine selected global markets and their sizes. Now we are going to move from the economy to the markets, which will conclude our presentation. We will start by looking at 9 selected global markets and their sizes. Number 1, the annual trading volume in the global foreign exchange market at the end of 2021 was $1.8 to $2.4 quadrillion. Number 2, the global bond market was $318 trillion for 2024. Number 3, the global equity market. The size of this global market was $115 trillion in 2023. The U.S. equity market was $51 trillion, and that market was overvalued. The Chinese equity market was not even half of that at $12 trillion. That market was undervalued. The European Union equity market was $10 to $12 trillion. Those stocks were undervalued, but EU stocks consistently paid higher dividend yields than US stocks. And that's been a long-standing trend because of lower valuations. European firms emphasize stable income for shareholders, not just capital gains. Less buyback activity. US firms often return cash via buybacks. EU firms do it more via dividends. If our top 3 were strictly countries, Japan's equity market would have been number 3 at $6 trillion, with its stocks being thought overvalued. Capitalization divided by GDP. Number 4, the global crypto market was $18.83 trillion in 2024. This market was overvalued in terms of use cases, but undervalued in terms of future potential. Then we have number 5, the market for U.S. money market funds. Number 6, the global loans and credit markets. Number 7, precious metals. Number 8, uranium and enriched uranium market. And number 9, the markets for rare earth minerals, mining and processed. The performances of the US dollar against emerging and developed baskets of currencies. The value of the US dollar can be determined by one of two baskets of currencies: emerging market currencies and, more often, developed market currencies. The US dollar index, emerging markets economies, DTWEXEMEGS, tracks the US dollar relative strength against a basket of currencies in emerging markets. This index is a macroeconomic indicator published by the Fed. It isn't a tradable security. Based on the Federal Reserve's trade-weighted currencies as of December 18, 2023, the top emerging market currencies, representing a total weight of over 50% of this basket, 53.1%, in descending order are the Mexican peso, MXN, at approximately 14%, the Chinese yuan, CNY, at approximately 13.4%, the Indian rupee, INR, 3.1%, the South Korean won, KRW, approximately 2.5%, the Brazilian real, BRL, approximately 2.3%, the Taiwan dollar, TWD, approximately 2.1%, the Singapore dollar, SGD, approximately 2%, and the Thai baht, THB, approximately 1.7%. On April 30th, 2025, this index was 135.41. The US dollar weakened 2.69% in the emerging markets economies from the start of 2025, when it was 139.15. The US dollar index, developed markets currencies, DXY is the ticker symbol, tracks the US dollar relative strength against a basket of weighted currencies in developed markets. Number 1, the euro at 57.6%. Number 2, the Japanese yen at 13.6%. Number 3, the pound sterling, 11.9%. Number 4, the Canadian dollar, 9.1%. 5, the Swedish krona at 4.2%. And 6, the Swiss franc at 3.6%. On April 30th, the DXY was below 100 at 99.47, indicating the US dollar weakened 9.07% in developed markets from the start of 2025, when it was 109.39. Gold, silver, Bitcoin, and Ethereum. Gold rose 23.74% from the beginning of the year to April 30th, 2025, and silver moved to 32.62. Bitcoin was $94,791.36, and Ethereum was below 2,000 at 1,808.33. Since the beginning of this year, The highest asset appreciation of the four was with gold. Competitive performances of small cap, mid cap, and large cap markets. From January 2nd, 2025 to Wednesday, April 23rd, 2025, the Russell 2000 small cap was down 14%. The Nasdaq Composite was down 13.3%. The S&P 400 mid-cap was down 10.5%. The S&P 500 was down 8.7%. The Dow was down 6.6%. The Dow was down the least. This bearish activity was seen on all 5 of these U.S. equity markets. The S&P 500 market capitalization to GDP ratio, the Warren Buffett indicator. Are U.S. stocks undervalued, fairly valued, or overvalued? The S&P 500 market cap to GDP ratio, also known as the Buffett indicator, was 167.58% at the end of 2024. Hence, U.S. stocks were and are considered strongly overvalued. Performance of market sector ETFs. In 1999, Morgan Stanley, Capital International, MSCI, and Standard & Poor's created the Global Industry Classification Standard, GICS, which divided the stock market into 11 sectors. In slides 23A and 23B, the 11 sectors are shown. As of Wednesday, April 23, 2025, year-to-date performance is led by the consumer staples sector, ticker symbol XLP, increasing by 4.34%. Global versus international mutual funds and mutual funds covering China. We have looked at the markets by industry sectors. The market can also be divided by global funds including U.S. stocks or international funds excluding U.S. stocks. This slide shows these types of funds. We are also going to look at China, the number 2 country by GDP. On the close of April 23, 2025, the Fidelity Overseas Fund, including U.S. stocks, with a year-to-date return of 8.72%, performed better than the Vanguard International Fund, excluding U.S. stocks, with its 6.07% year-to-date return. Investors may be cautious about investing in China due to its socialist market economy, where state-owned enterprises, SOEs, often pursue policy-driven or strategic objectives rather than prioritizing profit maximization. For investors accustomed to dividends, quarterly earnings, and profitability, a China fund that emphasizes dividend-paying companies can be a more familiar and appealing choice. As of April 23, 2025, the Matthews China Dividend Fund had a year-to-date return of 8.81%, outperforming the Fidelity China Region Mutual Fund. which posted a year-to-date return of negative 0.13%. Once the bear ran off the bull in our date range, large cap value, understandably risk off, did better than large cap growth. However, in March and April of this year, growth did better than value. Unlike 2024, in 2025 so far, categorically, the small cap growth mutual funds did better than the small cap value mutual funds, as evidenced by the T. Rowe Price Small Cap Stock Fund, a growth fund, in comparison to the Brandis Small Cap Value A Fund. This is the end of the presentation. At the end of this video, if you are leaving a reaction, comment, donation, deciding to follow me on LinkedIn, or subscribing to my channel on YouTube, thank you.